Most people think of Social Security and Medicare as two separate things, two separate programs, two separate decisions, two separate government agencies handling two separate parts of your retirement. And in many ways, they are. But there is a connection between Social Security and Medicare that almost nobody talks about, that can quietly add hundreds of dollars to your monthly expenses without a single letter of warning, and the people who get hit by it are almost always the people who made what seemed like a perfectly reasonable financial decision a few years before retirement. Today we're pulling that connection apart, showing you exactly how Social Security and Medicare interact, where the hidden costs live, and what you can do right now to make sure this connection works for you, instead of against you. Stay with us, because by the end of this video, you will understand something about your retirement finances that most financial advisors don't explain clearly enough, and that the government certainly isn't rushing to tell you. Welcome back to Medicare Exposed. No commissions, no plans to sell, no agenda. Just the truth about Medicare and Social Security every single week. If you're new here, subscribe right now. Let's get into it. Let's start with the most direct connection between Social Security and Medicare. And it's one that surprises almost everyone when they first hear it. Medicare Part B premiums are automatically deducted from your Social Security check, not billed separately, not invoiced, taken directly from your Social Security payment before it ever hits your bank account. So if your Social Security benefit is $2,000 per month and your Part B premium is $174.70, your actual deposit is $1,825.30 every month. Now that sounds straightforward enough, but here is where it gets complicated and expensive. The complication is called IRMAA. We covered IRMAA in video 8, but today we're going deeper, because the interaction between IRMAA and Social Security is where the real damage happens. Here's a refresher. IRMAA stands for Income-Related Monthly Adjustment Amount. It is a surcharge that Medicare adds to your Part B and Part D premiums if your income exceeds certain thresholds. And here is the critical detail. Medicare uses your income from 2 years prior to determine your surcharge. Not last year, not this year, 2 years ago. In 2024, Medicare is looking at your 2022 tax return. Now here is where Social Security enters the picture in a very specific way. When you claim Social Security, your Social Security income becomes part of your total income for the purposes of IRMAA calculation. But here's the trap that almost nobody sees coming. Social Security income is calculated at 85% inclusion for federal tax purposes for most middle and higher income retirees, which means if you receive $24,000 per year in Social Security, up to $2,400 of that is counted as taxable income, which is then counted toward your IRMAA threshold, which determines how much extra you pay for Medicare. Do you see how these two programs are feeding into each other? Your Social Security income affects your IRMAA calculation. Your IRMAA calculation affects your Medicare premium. Your Medicare premium is deducted from your Social Security check. It is a loop, and if you're not aware of it, you can walk into retirement with a very different monthly income than you expected. Let me show you exactly how this plays out with real numbers. Let's say you and your spouse both claim Social Security at 65. Combined Social Security income, $48,000 per year. You also have $30,000 in IRA withdrawals. Total income, $78,000. At that income level in 2024, you are comfortably below the IRMAA threshold for a married couple, which starts at $206,000. No surcharge. Standard Part B premium. Now let's say instead, you sold a rental property the year before you retired. That sale generated $180,000 in capital gains. Suddenly, your income for that year jumps to $258,000, which is above the IRMAA threshold. 2 years later, when Medicare looks at that year's return, you are now paying IRMAA surcharges, even though the property sale was a one-time event, even though your current income is back down to $78,000, even though you're living a completely normal retirement. Medicare doesn't care about this year. Medicare cares about 2 years ago, and it is quietly deducting hundreds of extra dollars from your Social Security check every single month because of a financial event that is long over. This is exactly the situation where filing form SSA 44, the IRMAA Life Event Appeal, can save you thousands of dollars. Now let's talk about a second connection between Social Security and Medicare. That catches people off guard in a completely different way. The timing of when you claim Social Security directly affects your Medicare enrollment options. Here's how. If you claim Social Security before you turn 65, you will be automatically enrolled in Medicare Part A and Part B. When you turn 65, your Medicare card will arrive in the mail, no action required. But here is what many people don't realize. That automatic enrollment means you are enrolled whether you want to be or not, which means if you are still working at 65, still covered by employer insurance, and you claim Social Security early at 62 or 63, you will be automatically enrolled in Medicare Part B, and if you don't take action to actively decline Part B, you will be paying that £174.70 per month premium, on top of your employer insurance, for coverage you may not need or want yet. Now the reverse situation is equally important. If you have not claimed Social Security by the time you turn 65, you will not be automatically enrolled in Medicare. You must actively go to Medicare.gov or SSA.gov and enroll yourself. And as we covered in video 1, missing that enrollment window has permanent consequences. So the decision of when to claim Social Security directly affects whether your Medicare enrollment is automatic or manual. And getting that interaction wrong, in either direction, can cost you money you didn't expect to spend. Let's talk about the third connection, the Hold Harmless provision. This one is a protection most Medicare beneficiaries have, but almost none of them know about it. Here is how it works. By law, your Social Security check cannot decrease from one year to the next, due to Medicare Part B premium increases, if you are already receiving Social Security benefits. This is called the Hold Harmless provision. What it means in practice is that if Medicare raises its Part B premium, but your Social Security cost of living adjustment isn't large enough to cover the increase, your Part B premium increase is capped to ensure your net Social Security payment doesn't go down. This protection saved millions of beneficiaries money in years where Medicare premiums spiked, while Social Security COLAs were small. However, and this is important, the Hold Harmless provision does not apply if you are not yet receiving Social Security, which means people who are enrolled in Medicare but have delayed claiming Social Security pay the full Part B premium increase with no protection. This is one more reason why the timing of when you claim Social Security and when you enroll in Medicare are decisions that need to be made together, not independently. Let's now talk about the practical implications of everything we've covered. Because this video isn't just about understanding the connections, it's about using that understanding to make better decisions. Practical implication. Number 1. If you are planning a large income event before retirement, a property sale, a large Roth conversion, a business sale, a large IRA withdrawal, run the IRMAA numbers before you pull the trigger. Understand what that income spike will do to your Medicare premiums 2 years later. Sometimes the timing of a financial transaction, by as little as 1 month, can put you in a completely different IRMAA bracket, or keep you out of one entirely. This is exactly the kind of planning that a good financial planner or CPA can help with, and the savings can be substantial. Practical implication. Number 2. If you claim Social Security early and are approaching 65, know that your Medicare enrollment is automatic. Set a reminder to review your Part B enrollment and decide whether you want to keep it or whether you need to take action based on your current employment situation. Don't let the automatic enrollment catch you off guard. Practical implication. Number 3. If you have not claimed Social Security by 65, do not assume Medicare enrollment is automatic. It is not. Go to Medicare.gov and enroll actively during your initial enrollment period, which opens 3 months before your 65th birthday. Missing this window because you assumed it was automatic is one of the most expensive assumptions in retirement planning. Practical implication. Number 4. When you are calculating your expected retirement income, don't calculate Social Security and Medicare costs separately. Calculate them together. Your real monthly Social Security income is your gross benefit, minus your Part B premium, minus your Part D premium, minus any IRMAA surcharges, minus your Medigap or Medicare Advantage premium. That is your real number, and for many retirees, that real number is $300 to $600 per month lower than the gross Social Security figure they've been planning around. Know your real number before you retire, not after. Social Security and Medicare are not two separate retirement decisions. They are two deeply interconnected systems that affect each other's costs, affect each other's enrollment requirements, and affect each other's protections. Understanding that connection before you make either decision is worth thousands of dollars over the course of your retirement. That is why this channel exists. Every week, one more layer of the retirement system, pulled back and explained in plain English. Hit subscribe and turn on notifications, because next week we're covering Medigap, the supplement plans that protect you from Medicare's biggest financial exposure, and the one plan letter that most Medicare advisors recommend above all others. You do not want to make the Medicare versus Medigap decision without watching that video first. We'll see you there.